What is going on? I hope you guys like the new change here. It looks pretty nice, right? I hope you like it. It looks nice to me. Damn, it's nice. I like it. The black and gold. Anyways, welcome to my channel. I'm the covered call guy, and my projected annual dividend slash options income is $82,561 a year, with about 6.8K a month, 1.5K a week, about $226 daily, and about $9.42 hourly. Yes, I've updated to kind of give a little bit more specifics. All right, maybe I should the next month I'll do an update on every second. Probably not. I'm kidding. All right, but the goal here on this YouTube journey is to create $120,000 in annual passive income using covered call ETFs. Legal disclaimer before I start, though: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice, because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, guys, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, today's video is requested by MSHII 2986, and the question was the battle for his core portfolio. How does STRC rank against other income ETFs such as SPYI, JEPI, and I added BTCI because if it's going to talk about crypto, why not, right? So this is a deep dive comparing his STRC against other income ETFs. All right, so we can talk about core portfolio suitability and structural risk and the yield decomposition of it. All right, so my goal here is we're going to be separating true structural income from dangerous credit arbitrage. All right, so first thing we're going to talk about is, of course, the new normal rate environment. So welcome to 2026. We're in 2026, right? While rates has been cut from the 2024 peaks, we are not returning to zero. As you know, the Fed right now has hold. They were expected to cut, but they're not. They're holding, they're pausing, right? So we're settled into a higher for longer structural floor until, of course, JEPI gets removed or something happens, right? So that splits us into two kind of fields here, right? The systematic risk premium, which just means systematic not systematic harvesting volatility from SPYI or JEPI, right? You monetize this part. We monetize fair. That's how we mix the premium, right? Even with a base rate of about 3.7 right now, the volatility spread remains a potent source of extra yield. Still good, not bad. We like it. All right, and then of course the idiosyncratic, which just means like single, isolated. It does not pretty much think of it like a single holding, right? The credit arbitrage, right? You're doing single thing like BTCI. It just does Bitcoin, right? So in this case, it's STRC, right? This one kind of like chasing leverage here, right? The quote unquote risk-free rate is 3.7, but STRC offers 11%, right? So you aren't just getting yield, you're taking a massive credit risk to bridge that gap when you buy this. At least in my opinion, the way I see this. All right, reality check here is rates settle at 3.7 and not 0, right? The yield requires risk, so choose wisely. All right, it got cut off, but I will try to fix that. The top just says, spoiler alert, why STRC might wreck your core. Why? Well, I broke it down into 4. One is structural mismatch, right? STRC fails as a core holding, in my opinion, because it stretches mechanism, the mechanism masses solvency risk until it snaps. It's binary. Either you get $100 or you face a credit event. Second is the quantitative inferiority. Adjusted for credit risk, STRC's real yield spread is about 7.3%. You got to actually do the calculation there, and you get about 7.3. Even then, yes, that is great yield. SPYI captures similar net yields via tax advantage volatility harvesting with 0 default risk. The third is the decay factor. I don't know if if you kind of like have thought about this, but BTCI offers about 27% nominal yield. But structural erosion is real if you do end up saying, I want to do Bitcoin, I want to go down this route. Right, paying high yield from a volatile asset creates SOR, right? Sequence of return trap here. All right, and then the fourth is always regulatory alpha. SPYI Section 1256 status gives you a 1% after-tax head start over STRC ordinary income for high earners. I don't know how much you're yielding or getting, but that's just something to think about. And then regulatory alpha just means things can change in the crypto world very, very quickly. All right, my verdict here is don't confuse your headline yield with structural integrity. When you're buying STRC, actually know what you're buying. You're buying, I would say, it's kind of a bigger risk when you want to get that, if you want to play crypto. 2026 settled rate grind set. I'm going to strip away the marketing and let's get down to what you're actually buying here, right? So the economic engine you're buying is, I think the SOFR baseline is about 3.7%. What does that mean? Secured overnight financing rate. Think of it as a risk-free baseline, what you're getting for lending money to the government overnight, right? If T-bills paid 3.7%, to get 11%, you must take risk. The question is, which risk, right? Credit default with STRC or market volatility like SPYI, right? The volatility regime. Crypto volatility remains 3 to 4 times that of equities. You see these swings. It drops crazy from the peaks of like 130,000 of Bitcoin now down to like 85, 90, 95, then back down to 80. It's crazy swings, right? So remember, volatility cuts both ways. It feels the yield, but it also feels the decay when the underlying asset drops, okay? Look at your goal. Beat the 3.7 risk-free rates without blowing up your principal. Defining core. What actually makes a portfolio anchor? When you talk about STRC, does it hold, the criteria here, right? Before we compare the tickers here, we have to define the rules of engagement for core positions, right? Should make up about 30% of your portfolio. Do you want to have 30% of STRC? I personally would not. I don't think I would even have STRC. And one, capital preservation, right? The rule here is the asset must not face binary jump to zero default risk. STRC fails here. Single issuer default is possible. Second is reliability. The rule here is income must come from recurring operations or structural premium, not refinancing. STRC fails here. Dividend funded by new debt. Think of a triangle and flip it upside down. Go ahead. Put your two thumbs together. Put your two pointer fingers together. Now flip it upside down. What do you get? All right, and 3 is diversification. The rule here, failure of one company should not tank the portfolio. STRC fails here, right? 100% concentration in Strategy Inc. or a core position of 30% plus of your portfolio. If it goes, you're pretty much a good chunk of your portfolio is gone. Reality check. STRC fails all 3 pillars of a core holding. I'm going to say SPYI and JEPI passes here. The infinite money glitch. I see this a lot when I was doing the deep dive here. I kind of came across this. A lot of people mentioning this. Strategy Inc., formerly known as MicroStrategy, operates a recursive financing loop. Number 1 is issue debt, right? Convertible notes or equity. Number 2, use cash to buy Bitcoin. Number 3, Bitcoin goes up, stock goes up. Step 4, repeat step 1 with higher stock price, right? So where does STRC fit? In quotes, I say it's permanent capital. Unlike debt, it has no maturity date, but unlike common stock, it doesn't dilute voting power. It allows them to leverage retail capital to buy more Bitcoin without technically adding debt to the balance sheet. Okay, it is a leverage bet on a single company, not a boring bond. So if you want that type of risk, right? You're taking on a lot of risk. You at least gotta expect the outcome to be worth it. That's something you're gonna have to make a decision on if it fits your core holdings. All right, let's look at it from the X-ray vision. What are you buying? I'm comparing it to SPYI, JEPI, and BTCI. All right, the tickers, you see it here, synthetic equivalent structure. All right, MSTR as BTC proxy plus short credit put. The payoff profile jumped to default. You act as an insurer. You collect premiums, which is the yield, as long as S MSTR is solvent. If they default, you pay out, lose your principal, upside is capped. SPYI, you know the game, Neos, long SP 500 plus short out the money call. Right, it's very asymmetric. You keep some upside up to the strike price. Downside is 1-for-1 with the market, but is buffered by premiums you collect. JEPI, long low volatility equity plus ELNs. Right, it's very out of the four is pretty defensive. Right, ELN's equity linked notes turns volatility into coupons, smooth income, lower beta. And then BTCI is the synthetic long plus active call selling. Right, it does have the recovery lag as you guys are pretty much seeing it. Right, participates in drops buffered by the premiums, but upside is capped by sold calls, hard to recover from drops. So you cannot see the payoff portfolio here. Right, you're taking that huge gamble with STRC, expecting a bigger payout. Right, my truth here is STRC short put portfolio means you take max risk for capped reward. Is that worth it to you? That's again your investor profile, kind of your tolerance here and what you're aiming for. Right, math doesn't lie. What do I mean by that? Right, decomposing the STRC credit spread. Right, the current STRC yield is about 11%, give or take. Risk-free rate of SOFR is about 3.7. Implied credit spread is 7.3. All right, so what is BPS? I'm just gonna, if you don't know what it means, basis point, right? 100 basis points means 1%, so 730 basis points just means 7.3%. Just putting out there, I'm sure you know, but for those who don't. All right, is this a scheme? This is one of the things I did come across too. In my opinion right now, no. It is very effective market pricing. The market is charging MSTR a 7.3% hazard pay, right, premium, because there is a real risk of default. It's not free money. It is danger money. Now, how much of your money you want to put into that danger money for that reward is up to you, right? The verdict here is you're taking an equity-like risk with total loss for a capped bond-like return. I'm going to say this is poor risk-reward ratio, but everyone has their opinions. I'm entitled to mine. All right, the objective, high yield isn't a gift. It is the price of risk. And as long as you're willing for that risk, again, I keep saying that because I don't know, maybe you're willing for that risk. All right, free lunch? Absolutely not. We talk about the VRP a lot, which is volatility premium, right? Harvesting the VRP, SPYI and JEPI do not take credit risk. They harvest volatility risk premiums. Simple English, since you asked for this video, I'm going to say investors pay extra for crash insurance, which is put calls. SPYI sells the insurance. The premium is the profit margin of the insurance seller, right? Risk adjusted for comparison here, STRC reward is about 7.3%. SPYI reward is about 8%. So that 7% does matter a lot when you have a lot of money in it, right? So in SPYI, the bad outcome is making less money than the market. And STRC, the bad outcome is losing your principal. All right, my verdict here is I'd rather miss the moon than hit the ground here. I'm going to side with SPYI all day, every day. All right, correlation. Will it save you from a crash, right? A core holding should stabilize your portfolio, right? That's the whole point of having it as a core. Let's look at SPYI and JEPI correlated to S&P 500 in a recession crash. Drops with the market, but dividends does cushion the fall. STRC, credit plus Bitcoin. I'm going to say this gives you a double whammy, right? You're getting punched left and right here. Credit spread widens, bad for STRC, and risk asset dump, bad for MSTR. Collateral, STRC offers no diversification. You are straight BTC. Right, and then of course U.S. Treasuries, right, usually goes up in price, flight to safety. My takeaway here is STRC is not a bond proxy. In a crash, it acts like a leverage equity. It does not hedge your stock portfolio, so it doubles down on the risk. The warning: if you do buy this, STRC correlates with risk assets exactly when you need it not to. All right, the silent killers, convexity and duration. STRC has negative convexity, right? It has infinite duration as perpetual. It has no maturity date, like I mentioned before. It acts like a very long-term bond. The convexity trap behind that is convexity is just how price changes when things get crazy. STRC has negative convexity, meaning it won't go up much, like example, capped at $100, but it can crash hard if credit falls, aka zero. right? SPYI is bounded convexity. Duration is negligible. Behavior in a negative 10% market correction. SPYI might go down 8% because the option premiums buffer the fall. STRC could be down 15% or more if credit spread widens. The risk here is that STRC gives you all the pain with strictly limited gain. All right, so under the hood, let's look at the refinancing loop, right? Dividends from debt. MSTR issues convertible notes, which is debt, to raise cash. They use the cash to buy Bitcoin and pay operations. The cash flow gap, their software business generates about $128 million revenue. The annual obligations approaches almost $700 million. They are technically burning cash on an operating basis. All right, the loop here is STRC dividend is funded by this capital market activity. They are effectively borrowing from new investors to pay you. If the market stops lending to MSTR, the dividend stops. All right, let's look at the reality here. You're being paid with borrowed money, not software profits. Okay, guys, if you're still watching, let's go ahead and put our two dumps together, put our two pointers together, and let's turn it upside down. All right, what do we get here? What are we having? What are we seeing? Okay, BTCI, the sequence of return trap. Okay, I talk about the pro, I talk about the cons. I'm trying to be unbiased because that's not what I do here. I don't have any favoritism. If I myself buy something that ends up being crappy, I'm gonna say it. Right? BTCI does have the decay mechanism. What do I mean by that? I'm gonna be clear here. BTCI sells calls on BTC futures and reference assets, right? The trap that it can lead to is not just that BTC drops, it's the path. If Bitcoin drops 20%, BTC drops also. Obviously, the underlying, right? If BTCI rips 20%, BTCI is capped by the calls it sold. The result, you can take the elevator down, but you're gonna have to take the stairs back up. You don't often get back to par, right? Even if BTC does. The pro here, though, massive 20% nominal yield, right? Captures BTC volatility perfectly. I'm going to say is a little bit better for a short-term tactical income. The cons, performance drag, right? Tax inefficient. Right now, we don't know if it's ordinary or rock until end of the year. Of course, they can put out their Notice 19A alpha, but of course, you should always say, look, I might have to pay taxes on this. That's why I leave it in the cons. Yes, you can rip me apart in the comments. All right, capped upside prevents capturing the full BTC moon scenario. I still love BTCI, but I do have to give an unbiased take here, right? My verdict here is BTCI is at least a rental, not a core holding, right? As long as you understand that it is a satellite position, right? The real yield after tax math, right? It's not what you make, it's what you keep. We're gonna say, let's say that we invest $100,000 into each. The gross yield for STRC, right? Ordinary income is 12%, $12,000. SPYI, 12%, $12,000 by using 1256 contracts. Fed tax rate at the top bracket, right? 37% versus 26.8% at a blended rate. Tax owed for STRC, if you hold it, right, about $4,440 versus SPYI, $3,216. Your net income is huge. You lose about $1,224 per year, right? 1.2% of the principal just by choosing the wrong tax structure, right? This compounds massively over time if you plan to hold it for a long time, right? SPYI gives you an instant 1.2 quote-unquote raise via tax efficiency here, right? Let's do a stress test. Bull, bear, or grind, right? Let's do an estimated 12-month total return projection of expected value, right? I'm going to say here in the bull market, goes up 20%. STRC goes up about 11%, right? Capped at par. SPYI captures for almost everything at 18%, and BTCI, because it's super volatile, captures about 45%. Right, so the grind 50%. STRC, I would say it still holds at 11. SPYI is still optimal at 12, and PTCI offset DK with 15%. And then credit shock, right? Of course, this market goes down 30%. STRC is gonna drop anywhere, I could say, like as much as 40 to 60%. SPYI, because it's buffered, -10. BTCI, because it's super volatile, probably dropped like 35, right? My analysis here is that STRC has the worst expected value because its downside is catastrophic, while the upside is strictly limited. STRC loses big in the worst case and wins small in the best case. All right, regulatory risk, right? The fast pay trap. I just want to put a disclaimer for here. I did find this interesting. Right, I'm not financial advisor, so it's just the Treasury regulations of 1.7701 section I-3. Right, it just targets a fast pay stock because STRC manipulates dividends to fix the price. The IRS could view it as a bond. If reclassified, you lose tax benefit and face filing headaches if you don't have a tax account, right? And then, of course, the institutional buyer strike. Many institutional compliance department banned the purchase of fast pay securities due to the reporting requirements, right? It's too much of a headache, right? So this removes the biggest buyers from the pool, hurting liquidity. And I always talk about assets under management and liquidity. It matters, right? It's a good bonus here, though. Complexity is a risk factor. STRC is complex. SPYI is simple. Right, liquidity, can you get out? All right, so SPYI, JEPI is very liquid. I love it, right? Of course, big banks create or redeem shares daily. Volume is in the millions to billions. You can sell 100 million in seconds. STRC, I'm going to say, it's a little bit more illiquid, right? Structure is corporate preferred stock. Mechanism here is not, as there's no creation or redemption mechanism here, right? Supply is fixed. If everyone rushes for the exit, there is no market maker obligated to buy. Prices could gap down 20% in minutes on low volume because now they can set the price for you to get out. My warning here is liquidity is oxygen for the stock market. You only notice it when it's gone, and when it's gone, it's going to be a world of pain. Okay, don't panic, but you probably will. I'm gonna say here is, right, the greatest risk is psychology, right? Retail investors equate $100 par with safe. The panic cycle is if STRC drops to $90, the bond substitute illusion shatters, right? Panic selling ensues, driving price to 60. Then pretty much from there, it disconnects from the fair value, right? But what if, right? This is the Steelman rebuttal. Right? I like to give the pros and the cons here. But what if BTC goes to $500,000? My response: if that happens, you would make 400% owning MSTR common stock. Why accept a capped 11% return for a thesis that implies massive upside, right? Again, that leads to the psychology. When the peg breaks, the illusion shatters. STRC is the wrong tool for the bull case. All right, my final verdict here is SPYI and JEPI, I approve. You buy that all day, every day. Structural VRP is robust. Diversification and tax efficiency wins. Of course, target to 15-25% to your core. STRC, I'm going to say reject this as a core. Why would you even think about this as a core, right? Tactical credit instrument, concentrates risk, limit 2-5% max, especially if you're new. I wouldn't even touch it. BTCI is speculative, right? Watch for the decay, reinvest 100% until you don't need to. I would say limit this to no more than 5% of your portfolio unless you absolutely know what you're doing. The strategy is to build your house on the rock, SPYI. Don't build your house on sand, which I'm going to say is STRC here. And that is all. Thanks for watching. Hope this was informational. There was a lot of things I should have put into STRC in the video here, but I would have got a little off topic. As you know, I do think if you put your two thumbs together and your two pointer fingers together and flip it upside down, I kind of almost let down the path of making this video about that, because from what I'm reading online and doing my research and just kind of, it gets a little worrisome. So hopefully this video, saved you from the infinite money glitch that I keep seeing when people keep mentioning about this, right? Let me know in the comments, right? Are you still SPYI, or your team leverage with STRC? Because it's a risk, but if you're willing to take that risk, you might be rewarded. All right. Thanks for watching, guys. Catch you guys on the next. And if you want another video of your topic, just let me know. Write it down in the comments, and I will do my best to make a video on that. Catch you guys on the next. Stay tuned.